All right, welcome back to the next Knox B2B Podcast. As you can see, the tables have turned. And now Jay is going to be asking me questions about some of the aspects of financing some of these real estate investments. So, Jay, thank you for being an interviewing me this time.
Thank you for allowing me to turn the tables on you.
Absolutely.
So, first question I have for you, what advice would you give to a first-time home buyer in the market?
A first-time home buyer? Well, it'd be very easy. The first thing you should do is talk to a lender. Talk to someone who is you know and trust, and it's okay to talk to several. And the best time to start is about 12 months before you want to buy a home.
Perfect. So, does credit matter in this situation? What is the minimum credit score? Or I heard minimum credit score was 620. Could they get away with lower?
Absolutely. Some folks will advertise as low as 500, but there's so many caveats to get that. The lowest in general is 580. But everyone's situation is different. So once again, talk with somebody who you know and trust, and they can guide you through the process. The really good ones, instead of throwing you to the wolves of credit repair, they will actually walk you through the process yourself to get you where you want to be before you buy your home.
Perfect. And I feel like today, you got to interview everyone else, get to know the history. Let's hear the history of Berton. How did you get into the mortgage world? What did you do before?
Okay. So I've been in corporate business development my entire career. So I've spent my entire career in business development for a number of different companies. I've worked for Fortune 1000 companies. I've worked for tiny startups, pretty much always in business development and marketing. I've also done some project management, and I've done some business analytical metrics on the side. So that has been my world, and it was up until last year. The corporate life was just sucking my soul dry. I was unhappy, and I was dreading Mondays, and so literally just walked away. Took a little bit of time to think about what I wanted to do with my life, and I met a branch manager of a local lending company, and he had the right business philosophy. He handed me a book called The Go-Giver by Bob Berg, and I recommend that book to anyone who wants to have a really clear human perspective on what business should be and can be. And that's what sold me. And so I've been working with him ever since. Since then, I've started my own commercial lending company as a broker, and I also have a little tiny company that does some hard money lending.
Perfect. I actually never heard of that book, so I'll definitely have to go.
Great, good read.
Take a look at it.
Yeah.
Next question. Can you walk us through the day-to-day process of what a mortgage lender does start to finish?
So generally what I do is I'll spend my first part of the morning doing some marketing. I'll respond and answer and do a little posting on socials. And then I have a block of time set to reach out to folks, whether that be in realtor partners, investor partners, or folks who have reached out to me who need some help with one thing or another, connecting with other people. My afternoons and sometimes evenings are spent talking with people through what their needs are, and then working deals and making sure things are appropriate. And then I do a little bit of research as well, because as a broker, there's a lot of different opportunities to work with different wholesale lenders who can offer different types of products that can meet a person's needs better than just one product. So that's my basic day.
Perfect. So for the first-time home buyers, or just any buyer that doesn't know about the lending process during a transaction, can you walk us through that?
Sure. To purchase a home. So assuming you've talked to your lender a few months before, and your credit and finances are square, you want to submit an application to get the information that the lender needs to qualify you, and then after that, the next step is to submit your paperwork, which verifies that information. Once that's done, then the fun part comes, which is to go house shopping. And once you've found a house and are in contract, you notify the lender, and then the lender basically takes your file and that house, and that goes through processing. And so a processor is going to work with underwriting. And underwriting, they're the folks who look at all the documentation to make sure everything is compliant with what the regulations. They make sure that the income has been calculated properly. They make sure that the property is what it says it is. They also get an appraisal for the property, which shows that it has the actual value that you're looking for. And then title is another company that gets involved, and they're the ones who make sure that the land is properly recorded. They make sure there's no liens against the property. And so those are all working in tandem. And of course, as a responsible home buyer, you're going to be getting an inspection. which is to look at the home and make sure it's functional and you're getting what you're paying for. Whereas the appraisal, which is different, that's for the lender, and they're making sure that the home is worth what you're paying for. So once all that comes together, the processor is the glue who keeps everybody coordinated, then toward the end, you're going to get your documentation, which says, here's the final documents, this is what it's going to cost to make it happen. And then happiest day comes when you sit down at closing, everyone signs the documents, and you get your property.
That's perfect right there. I appreciate you breaking that down, because I know there's a lot of people that are oblivious to what happens on that side.
Sure. Well, there's a saying that says everybody likes to eat sausage, but nobody wants to see it being made. And so I like to help my customers stay on the eating side of things. So we'll share as much information or as little information as they want, but at the end of the day, we want to make sure that it's a smooth process and don't want to bog them down with the details unless they like them.
So they won't feel overwhelmed.
Exactly.
Buying
I think
a house,
it can be.
Yes,
It can
be overwhelmed.
We'll stress for you, okay? Don't worry about it. We'll get you taken care of.
As we all know, mortgage rates have been up for about a year now. Do you expect them to come down? What should a buyer look out for? What influences mortgage rates, and do you see them coming down in the next couple of months?
Great question. Everybody asks that. So first thing I'm going to say is everybody's crystal ball is broken. No matter what the analysts say, they're all wrong because nobody knows what it's going to be. And it's a little bit of a story behind that, right? So we have about 110 years of data in what interest rates have been. And we as a society have gotten used to very, very low interest rates, unusually low for about a 5-year period where they were all in the 4, 3, some people even have, a 2 some point something interest rate. Those rates are probably not going to come again in our time. So let's look at that 110-year history. For 5 years of that history, rates were less than 5%. The rest of the time, they were always higher than that. So our interest rates high right now, they are higher than we're used to. But typically speaking, between 5 and 7% is the norm. If you ask somebody in the 1980s what interest rates were, when they were paying 10, 11% interest rates, I mean, those today are incredible. We can't even contemplate that. But that has happened. It may happen again. You never know. So what influences interest rates? So there's a number of factors that influence it. Some people say, well, it's the Fed, right? The Fed they've set the rate at that. That is not the case. So the Fed has an influence on it, but it's a very slow influence. So the Fed is setting the overnight rate for that banks use to lend money from one to another. And so that has an effect on the money supply in our country, but it doesn't directly affect mortgage rates. What directly affects mortgage rates are investors. So when a person gets a mortgage, that mortgage is bundled with other mortgages of a similar nature, and then they are offered to investors who are looking for a long-term investment. So you get a group of good mortgages, and those mortgages are going to pay over 20 or 30 years a certain percentage of interest, and that's profit that a person, if they buy the mortgage, they get that money over that time. So these bundled mortgages are put together in what's called a mortgage-backed security. So a security is an investment vehicle that people use to invest and get a return on their investment. So mortgage-backed securities are sold on the stock market. And that is what has a direct influence on interest rates. So if there's a greater demand for mortgage-backed securities, then the price tends to go up. And if there's less demand, then the price tends to go down. So the reason we had super low rates for such a long time was because the Fed was creating artificial demand by using treasury money to buy mortgage-backed securities. So it wasn't investors buying it, it was the government. And that was government policy at the time, was to keep rates as low as possible so that they would stimulate the economy. And it probably went a little too far because we all got used to 3 and 2 and 4% interest rates. Well, when they stopped doing that, well, then nature took over, and the rates have gone back to where they normally would be. And so it's more investor demand that is driving where we're at. So that's a little bit of a dive into what affects interest rates. And they do change a little bit every day, and they tend not to have huge shocks unless there's something really bad that happens, like a war or terrorist attacks. Then that changes, and government policies will sometimes change it. For example, when the president recently was talking about tariffs, that was a little bit of a shock to the system. But it's all about long-term and short-term investment, and where the government's investing their money and where people want to put their money. That's all has a little bit of a factor on interest rates. So going back to your original question, are they going to go down? Yes. We probably won't see them as low as they were before. Are they going to go up? yes, they will probably go up as well. So I'm saying right now we're at about, the interest rate's going to vary depending on a person's credit and what loan program they're using. So right now we're hovering around 6.75 and 7. And if somebody's watching this in 10 years, who knows what it's going to be? If somebody's watching this in 2 months, who knows what it's going to be? So I'd say we're right now about normal is where it's at. Not really high, not really low. It's kind of, historically, it's about normal.
So what would you say to the people out here that feel like they're locked inside their house?
Yes.
Because they have a 2%, 3%, 4%, 5% interest rate.
Right.
And when they buy now,
Right.
that's going to go up to around 7.
Right. That is a great question. So that is going to, what I would say to them is what you need is going to depend on your specific situation. If for many people, stay in that house and keep that rate as long as you can. For other people, let's say for other people, let's say they bought that house as a starter home and they want to grow their family. Well, that house is going to be too small, depending on how many children they have, right? So you have to move. And so, it was great while it lasted. I would say maybe keep the house as a rental and then buy another house if you can. Other people that I'm working with, they have an enormous amount of equity in their homes and they want to unlock that for investment purposes or to get out of debt. And rather than get a higher interest HELOC or HELOAN, they refinance the entire thing. And when you look at the interest they would pay on the second mortgage versus the interest they pay on the first, look at both and see how much interest you're paying as an aggregate. So many people want to hang on to that nice low rate, and it's not a bad thought. But it's also important to think, okay, but in aggregate, if I'm paying 20% interest on my credit cards right now, and I can pay those off in an aggregate loan, and I'm going to pay less interest, well, that might be a good reason to get a different loan. To get a loan, even though you're giving out that 3% interest rate, you're going to pay less interest over time. And the real bonus, talk to your tax advisor, is that mortgage loan interest is tax deductible. So there's a lot of different things, but there's no one right answer. It's going to depend on who that person is, what their goals are, and talk to someone who's going to help you meet those goals. But don't stay just focused on, I got to keep this no matter what, and you're bursting at the seams. Life is there to be lived, and good people will give you good advice to help you make the best decisions.
Well, I got another question for you. This is my last question. Kind of a fun question, but it's also a question for the younger viewers.
Great.
And the new investors in real estate, new agents.
Okay.
If you could go back to your younger self,
yes,
what advice would you give yourself about money and real estate?
Oh, great question. So if I were to talk to young Berton, I would say, buy your first home as a duplex. Live in half of it, rent the other. When you're ready to move to your second home, keep that as a rental and move in your second home and do that. And then by the time you've lived 20 years or so, you're going to have a series of rental properties supporting you as well as your existing home. I would say do that. Plan your finances so that you can move from house to house that way and keep rentals. The other advice I would give would be to save 10% of my income religiously in a low-cost S&P 500 index fund. I'm a fan. Long-term investment is great, and 12% year over year is hard to beat.
So, as far as buying a duplex as your first home,
yeah,
what type of loan would someone qualify for?
Well, that varies. Varies depending on the person's situation. How much money they have to put down, where the location is, the cost of the property, it varies.
Okay, so what type of loan, so what type of loans can a new investor get when they're getting their first rental property, getting their first home, or if they're house hacking, getting a duplex? What type of loans would they qualify for?
So this is a great question. So the beauty of a house hack is that it can be your primary residence. And generally speaking, lenders are going to look at your primary residence. You'll get very good interest rates. And anytime somebody's buying a primary residence, that's a great way to get into house hacking because you get the rental. And then when you leave to get your next primary residence, you're paying lower rates every time you move. So that's one strategy. Another strategy, let's say you're comfortable where you live, or maybe you don't want to move every 3 or 4 years. So there's so many options to get to invest. Let's start with one. It's called a DSCR, which is a debt service. I don't know, and I'm just going to retry that. It's called a DSCR loan, and essentially it takes the value of the rental, the income that property is generating, and it uses that income to qualify that person for the loan. And that's one way that people purchase properties without having to use their own income as the basis for the property. Now, you've got to have good credit and some money down and that sort of thing. So that's one option. Another good option that people do is they will find a distressed property, which is a property that maybe is beat up, needs a little bit of work, and they'll purchase that property at a low price. And then they will, as they purchase that property, they'll get what's called a fix and flip loan, which purchases the property, and it gives them a certain amount of money allocated for the repair of that home. So you've got to have a lot of things working together. You've got to have a good realtor who's going to help you know this property is at the right price, and also if you repair it, it'll sell at that price. So you've got to have good information there. You need to have a good contractor who has experience, who can fix it up, and who can give you a good quote and won't go over budget or take forever. And if you can get those things together and find those properties, then you purchase the home at a discount, you have the home get repaired, and then you either sell the home and make a profit, or you keep the home as a rental. That's another way to get involved. And then another way, some investors I'm working with, they find a plot of land and they buy the land and they buy the house with what's called a ground up loan. And a ground up loan purchases the land and purchases the construction price of the home, the construction for the home. And they essentially do the same thing as a fix and flip, only after the house is done, the same thing. You either rent it or keep it as your own home, or you sell it and make a profit too. So those are the three, I think, for investments that most people do. They'll use a DSCR, they'll do a fix and flip, or they'll do a ground up. Those are the ones that most folks are leveraging. Now there's many options too. You can get a second home loan and that sort of thing. But those are the three vehicles that most people use. And some people will do, not using a lender like me, they'll do seller financing. So let's say you find someone who owns a rental property and doesn't really want to manage it anymore. Networking and finding those people, maybe they're willing to sell you the property and you just make payments to them instead of making payments to a bank. So lots and lots of options. The person's goals, the person's tolerance for risk, and then the person's network, those are all going to be factors. And finding someone or finding a network of people who can help you connect with those is really going to be key to helping you be in the right place and make the right decisions.
Okay, I have one last question.
Fire.
Would you recommend seller's financing, or would you recommend just doing a normal loan through a lender or through a bank?
It's not as black and white as that. With seller financing, you and the seller got to get along and have a lot of trust. Generally speaking, seller financing is going to give you better terms. There aren't a lot of those opportunities available, but if you can find them. They're worth it. Other than that, find a lender that you know, like, and trust who can point you in the right direction and will give you good advice that's good for you and not good for them.
You guys hear that? That means get Berton. One of the best lenders out.
You're very kind. Thank you very much.
That's a wrap. I appreciate you for letting me turn the tables and interview you.
Great. Thank you very much. It's been a pleasure.